The Alpha Masters, Unlocking the Genius of the World's Top Hedge Funds, written by Maneet Ahuja, summarized by Detailed Book Summary. Don't forget to subscribe. Chapter 1. The Global Macro Maven Ray Dalio, Bridgewater Associates. What if everything you believed about how the world works was wrong? That's the question Ray Dalio, the founder of Bridgewater Associates, has built his life and fortune around. It's a question that doesn't just challenge our assumptions. It disorients us. It makes us uncomfortable. But for Dalio, discomfort is the starting point of insight. You see, in a world as complex and chaotic as the global economy, certainty is dangerous. Assumptions are landmines. And the only safe path forward is through radical open-mindedness, a relentless pursuit of truth, and the willingness to admit again and again that you might be blind to what really matters. Ray Dalio wasn't born into finance royalty. He grew up in a middle-class Long Island neighborhood, the son of a jazz musician and a homemaker. He bought his first stock, Northeast Airlines, at the age of 12, not because of a grand strategy or insider information, but because he thought airline stocks were cheap. The stock tripled. For a kid, that was magic. And that magic, that idea that information, intuition, and a little luck could unlock wealth, never left him. But Dalio didn't just want to make money. He wanted to understand why markets moved. Why did stocks surge one day and crash the next? What caused inflation? How did interest rates influence everything else? Most people accepted market moves as unpredictable. Dalio was obsessed with their underlying logic. He wanted to decode the machine. After earning an MBA from Harvard Business School, Dalio entered the financial world in the 1970s, a gritty, no-nonsense era on Wall Street. He started out at Shearson Hayden Stone, where he was almost fired for punching a coworker. Yes, that's right, punching. Dalio had passion but not polish. He was smart but raw. Still, he persevered. And eventually, he left to start Bridgewater Associates in his apartment. The turning point in Dalio's career, and perhaps the moment that most shaped his philosophy, came in 1982. Mexico defaulted on its debt, and Dalio, drawing on his macroeconomic analysis, predicted that a global depression was imminent. He bet big on that forecast, and he was dead wrong. The market boomed. Bridgewater lost clients. Dalio lost nearly everything. Most people would have folded. But Dalio chose something different, reflection. He realized that being smart wasn't enough. Certainty was a liability. What he needed was a way to question his own thinking before the market did it for him. That failure became the seed of what would later grow into one of the most distinctive investment philosophies in the hedge fund world. He codified this thinking into a set of principles, the most famous of which is, pain plus reflection equals progress. Dalio learned to view mistakes as data points, not defeats. To him, each error revealed a blind spot, a flaw in logic, a lesson in disguise. It was a radical inversion of the typical Wall Street mindset, where losses are signs of weakness and vulnerability is a liability. Dalio embraced both. But it wasn't just philosophy. Dalio turned these ideas into practice, into a system. And nowhere is that system more visible than in the culture of Bridgewater itself. Imagine working in an environment where every meeting is recorded, where your performance is continuously rated in real time by your colleagues, where even interns are encouraged, no expected, to challenge the CEO. Welcome to Bridgewater. To outsiders, it seems brutal. But to Dalio, it's the only way to build an organization capable of seeing reality clearly. He calls it radical truth and radical transparency. At the heart of this culture is the belief that the best ideas should win, regardless of where they come from. That means encouraging disagreement, promoting thoughtful debate, and detaching ego from insight. One of Bridgewater's most fascinating tools is the Dot Collector, a real-time feedback app that lets team members rate each other's contributions during meetings. Over time, a profile emerges, not just of competence but of credibility. The more accurate your predictions and insights over time, the more weight your opinions carry. It's called believability-weighted decision-making. And it's one of the reasons Bridgewater isn't just a hedge fund. It's a learning organism. But behind all this culture and process is Dalio's true edge. His understanding of the global economy as a machine. Most investors look at charts, earnings, market sentiment. Dalio looks at cause and effect. He sees the economy not as a mystery, but as a series of transactions. He breaks it down into its fundamental components: credit, productivity, interest rates, inflation, human behavior. He studies the relationships between these variables the way a biologist might study ecosystems. Everything is connected. Nothing happens in isolation. He even created a video watched by millions called How the Economic Machine Works. In it, Dalio explains that economies rise and fall not randomly but in cycles. These cycles are driven by credit expansion and contraction, which are in turn driven by human psychology and policy decisions. Understand the levers, he argues, and you can anticipate outcomes. This mindset informs Bridgewater's flagship fund, Pure Alpha. The fund doesn't bet on companies. It bets on economies. It uses models to simulate thousands of macroeconomic scenarios, asking questions like, what happens to bond yields if the Fed raises rates? What does a trade war do to commodity prices? How will a weakening currency affect inflation in a developing market? It's like 3D chess with the global economy, and Dalio built the board. During the 2008 financial crisis, when banks collapsed and portfolios burned, Bridgewater thrived. Dalio had spent years warning about excessive leverage in the system. His models didn't predict the exact date of the crash, but they recognized the conditions for one. When the world panicked, Bridgewater's playbook kicked in. The fund returned double digits while others suffered catastrophic losses. That wasn't magic. It was the result of preparation, humility, and systems thinking. Dalio didn't try to be a prophet. He tried to be a mechanic. But let's talk about the psychology behind all this. How does a person manage the stress of overseeing billions of dollars in capital, of making decisions that impact economies, companies, even countries? For Dalio, the answer lies in detachment. He sees himself not as a master, but as a student. He believes that we are all blind to our own weaknesses, and that the only way to grow is to constantly expose ourselves to better thinking. That's why he loves disagreement. Not because he enjoys conflict, but because it's the only reliable path to clarity. When someone disagrees with him, he doesn't ask, "Why are you attacking me?" He asks, "What might they see that I don't?" That's the humility of a man who's been burned and rebuilt. It's also the mindset of someone who understands that the real enemy is not the market, it's our own biases. So what can we take from Ray Dalio's journey? First, failure isn't fatal, it's feedback. Dalio's early mistakes didn't ruin him. They refined him. Second, success is not about certainty, it's about process. He doesn't trust gut feelings. He trusts models, data, and diverse perspectives. Third, truth is more valuable than comfort. In a world full of noise, Dalio chose brutal honesty, and it made him one of the most respected minds in finance. Perhaps most importantly, Dalio teaches us that you don't have to be perfect to win. You just have to build a system that learns faster than you fall. That adapts. That reflects. That grows. And as we leave his story behind and step into the next chapter, we're invited to ask a deeper question. If Ray Dalio's edge came from understanding the human machine, our biases, our behaviors, what happens when the machine stops being human? That's where we turn next. To Pierre Lagrange and Tim Wong, the minds behind Man Group's AHL division, where investing isn't driven by human instinct but by data, algorithms, and artificial intelligence. In Chapter 2, we step into the world of quant investing, where numbers rule and emotion is exiled. Let's go there next. Chapter 2. Man vs. Machine. Pierre Lagrange and Tim Wong, Man Group/HL. What if the future of investing wasn't human at all? That idea might sound unsettling at first, maybe even dystopian. We've always imagined finance as a human game. The arena where sharp minds battle with instinct, experience, and emotion. But Pierre Lagrange and Tim Wong saw something different. They saw a world where logic would replace luck, where emotion would be excised like a tumor, and where the real edge wouldn't come from charisma or gut feeling, but from code, numbers, models, machines. And they built that world inside Man Group's AHL. It wasn't always obvious that investing would evolve this way. Pierre Lagrange started out as a more traditional investor. Educated in economics and steeped in the classics of market theory, he appreciated the art of investing, the human judgment, the calculated risk, the occasional intuitive leap. But over time, the markets were changing. Speed was accelerating. Complexity was multiplying. Interconnectedness was rewriting the rules. And more it seemed that the human mind, no matter how well trained, couldn't keep up. That realization brought him to AHL, a firm with a radically different approach. Founded by three quantitative visionaries, Michael Adam, David Harding, and Martin Lewick, AHL wasn't built on forecasts or opinions. It was built on data, cold, hard historical data. Their founding belief was simple. Rather than trying to predict where the market would go, just build a system that reacts quickly and systematically to where it is already headed. That was the beginning of something new. But to evolve into something enduring, AHL needed someone like Tim Wong. Wong wasn't flashy. He wasn't the kind of trader you see in movies shouting orders or pounding the table. He was soft-spoken, deliberate, and surgical with logic. A mathematical mind wrapped in a calm demeanor. Wong joined AHL early in his career, but it wasn't long before he was helping shape the very foundation of how the firm thought and how it invested. Their shared thesis was bold but grounded. Humans are flawed. We're emotional. We panic. We get greedy. We fall in love with our own ideas. Markets may be driven by human behavior, but to profit from them consistently, one must transcend that behavior. So they decided to build systems that would never tire, never waver, never fall prey to ego or fear. These systems, algorithms if you will, would scan vast oceans of data, identify patterns, test them against decades of history, and act only when the numbers told them to. One of the most basic but powerful tools in their arsenal was trend following. It might sound obvious. If something is going up, buy it. If it's going down, sell it. But when you take that simple idea and back it with 50 years of market data, dozens of asset classes, and thousands of scenarios, you begin to see just how effective it can be, especially when executed with discipline and precision. The key, though, is that the model doesn't care why something is going up or down. It doesn't speculate. It simply observes and follows. During the 2008 global financial crisis, this approach proved its worth. As traditional firms fell apart, caught in the chaos of subprime mortgages and credit default swaps, AHL's models calmly adjusted. They weren't emotional. They weren't shocked. They simply followed the data. Their trend models shorted collapsing assets, bought into rising ones, and weathered the storm better than most. In a sea of panic, they were mechanical calm. But success comes with a paradox. When everyone starts using the same approach, the edge erodes. More firms began to adopt quantitative strategies, chasing the same signals, mining the same datasets. Markets began to adapt. A signal that worked for years could suddenly fade or reverse. And in a world where milliseconds matter, being second to act meant being last to profit. Tim Wong saw this coming. He understood that a winning model wasn't a static invention. It had to evolve. Markets are living organisms. They change, react, adapt. So AHL began building adaptive models, systems that could learn from new data, adjust their parameters, and evolve with the very market they were trying to master. This was the next frontier, machine learning, not just machine execution. At the core of AHL's philosophy was the scientific method. Every new strategy, no matter how promising, had to be rigorously tested. Hypotheses were formed, historical data was mined, simulations were run. If the results weren't robust across different markets and time periods, the idea was discarded, no matter how elegant it seemed. It wasn't about being right. It was about being repeatable, consistent, measurable. What made AHL stand apart wasn't just their tech. It was their humility. Wong and Lagrange built a culture that revered data over opinion, systems over personality. Decisions weren't based on charisma or conviction. They were based on statistical confidence. That mindset filtered into everything. Ego had no place at the table. And yet, humans were still needed. That's the surprising truth of quant investing. The machines can run the numbers, but they can't frame the questions. They can't decide which variables to examine, which risks to tolerate, or which blind spots to worry about. That requires human intuition, judgment, and ethics. The quants didn't eliminate people. They just moved them to a different role. From pilots to engineers, from traders to system designers. There were risks, of course. As we saw during events like the 2010 flash crash, algorithms can move faster than understanding. When too many systems react at once, without emotion, without pause, the result can be a cascade of trades, a market whiplash that no one saw coming. That's the danger of automation without oversight. So AHL and firms like it began building safeguards, kill switches, risk buffers, human monitors. Because no matter how advanced the machine, there must always be someone watching the wheel. Ultimately, the story of Lagrange and Wang isn't just about quants or models. It's about how we cope with a world that's too complex for intuition alone. It's about recognizing our cognitive limits and choosing to augment them with machines that don't sleep, don't flinch, and don't fool themselves. But what does this mean for us? What do we take away? It means that the game has changed. That investing today is as much about infrastructure as it is about insight. It means that the real advantage lies not just in ideas, but in the systems we build to execute those ideas, flawlessly, relentlessly, and without emotion. It also reminds us that technology isn't the enemy. It's a partner. The best investors of the next generation won't be the ones who resist it, but the ones who understand how to combine data with discipline, code with curiosity, logic with leadership. As the chapter closes, we see Lagrange and Wang not as soulless quants, but as quiet revolutionaries, men who saw what was coming and built something extraordinary to meet it. Their legacy isn't just in their returns. It's in how they changed the rules of the game. And now we shift to a different kind of master. One who didn't rely on machines or models, but on insight, on seeing what others refused to see. He bet against the housing market when no one else dared. And in doing so, he executed one of the greatest trades in financial history. In Chapter 3, we meet John Paulson. Let's turn the page. Chapter 3. John Paulson, Event/Risk Arbitrage. Every once in a generation, there's someone who sees the cracks before the collapse. Someone who watches the crowd celebrate, feels the pressure to conform, but listens to something deeper. A quiet conviction that the music will stop, that the party will end, and that when it does, most people won't be ready. That someone in 2007 was John Paulson. It's strange to think that one of the most legendary trades in financial history was born not from a wild risk, but from skepticism, from careful observation, from doubt. Paulson was not flamboyant. He wasn't known as a market rebel or a bomb thrower. He was a risk arbitrageur, a man who made his living from mergers and acquisitions, betting that deals would go through, capturing tiny spreads. Steady, methodical. But behind that methodical nature was a razor-sharp instinct, honed over years, to spot when something didn't make sense. By the early 2000s, the U.S. housing market had become the darling of the economy. Home values were soaring. Banks were handing out mortgages like candy, often to people who could barely afford to repay them. No income? No problem. Subprime loans, adjustable rate mortgages, teaser rates. It all fed a beast that few seemed willing to question. Homeownership was at an all-time high. Real estate was the new retirement plan. Everyone was all in. Everyone, that is, except John Paulson. He watched with a growing sense of unease. Something wasn't adding up. Why were people with no credit history being approved for $500,000 homes? Why were mortgage securities rated AAA when the underlying borrowers were clearly shaky? The more he looked, the more concerned he became. Paulson had no background in real estate, but he didn't need it. He understood human behavior, and he understood leverage. What he saw was a bubble, one built not just on hope but on denial. So he started digging. With a few trusted analysts, Paulson began pulling apart the structures behind the housing boom. Mortgage-backed securities, collateralized debt obligations, CDOs, and the credit default swaps that insured them. What they found was staggering. These CDOs weren't just risky, they were toxic. Made up of thousands of low-quality home loans, they were being sliced, diced, and repackaged into products that no one truly understood. And yet, institutional investors were buying them by the truckload. Paulson made a decision. He was going to bet that the whole thing would collapse. Not hope, not guess, bet. He didn't just short housing stocks, he went deeper. He used credit default swaps to buy insurance on mortgage securities. If those securities defaulted, he would get paid. And not just a little, a lot. It was a contrarian move, almost unthinkable at the time. The housing market had never declined nationwide. Everyone, from big banks to regulators to economists, believed in its strength. But Paulson trusted his research more than the consensus. The hardest part wasn't designing the trade. It was holding it. For almost 2 years, the market kept rising. CDOs continued to sell. Mortgage companies continued to lend. Paulson's position, large, lonely, and expensive, was bleeding money. Clients were confused. Other investors scoffed. But he didn't flinch. He had done the work. He knew what was coming. He just didn't know exactly when. And then it began. In 2007, cracks turned into fractures. Subprime lenders started failing. Borrowers began defaulting. Housing prices plateaued, then slipped. Panic set in. And Paulson's trade, silent, patient, quietly waiting, exploded into profit. His fund soared. The very instruments he had insured were failing en masse, and the credit default swaps were paying off like a jackpot. Investors who had stuck with him were stunned. Some made hundreds of millions. One of them said it felt like winning the lottery 10 times in a row. Paulson himself earned more than $4 billion that year. His fund gained nearly 600%. It wasn't just the most profitable trade of the decade, it was the most profitable trade in history. But here's what's remarkable. Paulson never gloated. There were no victory laps, no arrogant interviews, no celebration. He understood the gravity of what had happened. Yes, his clients made money, but millions of people lost their homes. The global financial system teetered on collapse. Paulson had been right, but it came at a cost to the world. And yet, from a professional standpoint, what he accomplished was extraordinary. He saw a false foundation and refused to build on it. He trusted his own reasoning when nearly everyone else dismissed him. And most importantly, he held the line. Conviction in markets is cheap. Holding conviction under pressure? That's rare. That's what makes legends. After the crisis, Paulson's firm ballooned in size. Assets poured in. He became the man with the golden touch. Clients wanted more. The media couldn't get enough. He launched new strategies, gold funds, recovery plays, merger funds. He made another huge bet on the price of gold, anticipating inflation. For a while it worked. But eventually some of those trades faltered. One of his biggest missteps was investing heavily in Bank of America and Citigroup, expecting a sharp recovery. But those positions didn't perform. Returns slipped. Critics began whispering that he'd lost his edge, that he was a one-hit wonder. But that criticism misses the point. John Paulson's legacy doesn't rest on the years that followed 2008. It rests on the trade that defined him, not just financially but philosophically. He proved that the market isn't always right. That consensus isn't always wisdom. That diligence, skepticism, and patience can still triumph in a system often driven by speed and noise. There's a lesson in that for anyone, not just investors but thinkers, creators, anyone who's ever gone against the grain. Paulson wasn't a visionary because he saw something others couldn't. He was a visionary because he acted on it. He put his capital, his reputation, his career on the line. And when the moment came, he didn't blink. So how does it feel to be that right? That early? That alone? Paulson has never really said. But maybe that's part of the lesson too. That success at its highest level isn't always about glory. Sometimes it's about quiet certainty. About doing the work no one else wants to do. About seeing the wave long before it crashes, and having the nerve to surf it. As the dust settled, and the world began to rebuild, Paulson moved forward. Still thoughtful, still methodical, still believing that the next opportunity would come not from noise but from silence. From seeing what others miss. From the power of being right when it matters most. In the next chapter, we meet two investors who didn't wait for catastrophe. They went looking for it. Marc Lasry and Sonia Gardner specialized in distressed debt. When companies were falling apart, they leaned in. Where others saw danger, they saw deep value. Their story is one of boldness, resilience, and the art of finding gold in the rubble. Let's keep going. Chapter 4. Marc Lasry and Sonia Gardner, Distressed Debt. Most people run from chaos. It's instinctive. When the markets collapse, when headlines scream disaster, when assets start to burn, the average investor backs away. But Marc Lasry and Sonia Gardner aren't most people. They walk straight into the fire. While others see broken companies and financial rubble, they see hidden treasure. Distressed debt trading at pennies on the dollar, misunderstood by most, but rich with potential for those patient and brave enough to look deeper. That's the secret to their empire, Avenue Capital Group. They didn't make their fortune during stable times. They made it in the wreckage. Marc Lasry's journey didn't begin in a boardroom or an Ivy League club. He was born in Morocco and raised in Brooklyn, where hustle was a survival skill and ambition meant working harder than everyone else. He didn't grow up rich, but he grew up observant, watching, questioning, calculating. He started his career at a bankruptcy law firm, reading the ugliest corporate stories you can imagine. But in those legal documents, in the court transcripts and creditor disputes, he started to see something most people missed: value. Yes, the companies were in ruin, but inside that mess was something salvageable. A contract, an asset, a legal loophole, something overlooked and underpriced. His sister Sonia Gardner saw it too. With a legal mind as sharp as his, she also trained in bankruptcy law, and together they realized something powerful. If you understand capital structures deeply, really understand them, you can not only survive corporate collapses, you can profit from them. And so they joined forces. In 1995, they founded Avenue Capital Group with a single mission: invest in companies others have abandoned. This wasn't glamour investing. There were no flashy IPOs or tech unicorns. This was the gritty work: digging through bond covenants, negotiating with creditors, working through court-appointed restructurings. And yet, this slow, deliberate, deeply informed approach paid off. Because when companies fall into distress, their bonds often collapse in price, sometimes to 20 or 30 cents on the dollar. But if you can predict which companies will survive, if you can endure the legal and operational uncertainty, you can watch those bonds rebound dramatically. That's what Avenue did, again and again. Lasry and Gardner's talent wasn't just in finding undervalued debt. It was in reading human behavior. Because in distressed markets, people act irrationally. They panic. They dump assets out of fear, not analysis. And that's where the opportunity lies. When everyone else is focused on survival, Avenue is focused on strategy. One of their early, defining plays came during the aftermath of the Asian financial crisis in the late 1990s. While the rest of the world fled Asian markets, Avenue leaned in. They looked at Korean debt, examined it meticulously, and found real value buried in the fear. It was classic Avenue. Don't follow the herd, watch it stampede, then calmly walk in the opposite direction. They bought at the bottom, and when the region began to recover, those investments soared. But their approach wasn't about being contrarian for the sake of it. They weren't reckless. Every position was scrutinized. Every legal detail, every restructuring scenario, every possible outcome, they examined it all. They didn't just want to be early. They wanted to be right. That mindset served them especially well during the 2008 financial crisis. When the world stood still, when Lehman Brothers collapsed and liquidity vanished, Avenue stayed active. They didn't freeze. They began buying bonds and loans from companies that others had written off: auto parts manufacturers, real estate developers, industrial firms. Most investors couldn't stomach the risk, but Avenue had built its entire business on that exact kind of moment. They knew that when markets overreact, prices become irrational. And when that happens, fortune favors the prepared. Their success wasn't just about making big bets. It was about how they managed risk. They diversified across industries and geographies. They avoided overexposure to any single position. And they never relied on hope. If a deal didn't make sense on paper, legally, structurally, or economically, they walked away. And despite the tough exterior of distressed investing, there was something else about Lasry that stood out: his sense of empathy. He didn't talk like a Wall Street tycoon. He talked like someone who cared about the workers losing their jobs, about the towns devastated by a company's failure. He knew the numbers, yes, but he also knew the stories behind them. That perspective shaped the firm's culture. It reminded everyone that even in bankruptcy court, even in high-stakes negotiations, people were affected. Over the years, Avenue expanded its reach into Europe, Asia, the Middle East. They managed billions, but they never strayed from their roots. They didn't chase fads or follow headlines. They stuck with what they knew: value in crisis. Because for Marc Lasry and Sonia Gardner, the greatest returns aren't found in moments of euphoria. They're found in moments of despair. They understood that markets are cyclical, that no boom lasts forever, and that after every collapse the pendulum swings too far. That's when they strike. When fear turns into mispricing. When debt becomes discounted. When the system forgets that even troubled companies still have factories, employees, intellectual property, and land. That's when Avenue goes to work. Not to exploit the weak, but to resurrect the forgotten. So what do we learn from them? First, that value is rarely obvious. You have to dig for it. Read the legal footnotes. Question the fear. Think like a builder in a demolition zone. Second, that being early requires patience. Avenue often waited years for trades to play out. They didn't chase monthly returns. They built legacy portfolios. Third, that empathy and capitalism aren't opposites. Lasry and Gardner showed that you can care about people and still win in the market. That a heart doesn't make you soft. It makes you grounded. In a world addicted to momentum, to speed, to shiny new things, they remind us that sometimes the best investments are in the places no one wants to look. Not in perfection, but in imperfection. Not in strength, but in struggle. And now, as we close this chapter, we turn towards someone very different. David Tepper. Loud, bold, unapologetic. A man who made his name not by quietly fixing what was broken, but by charging in, seizing control, and rebuilding it in his image. If Avenue Capital was the scalpel, Tepper was the sledgehammer. His chapter is next. Shall we continue? Chapter 5. David Tepper. Value/opportunistic. David Tepper doesn't whisper. He doesn't tiptoe. He walks into a room, into a market, into a disaster, with the posture of a man who knows exactly what he's doing. Even when no one else does. When others are reeling from crisis, Tepper is scanning for opportunity. While panic paralyzes most, he leans in. Not out of recklessness, but from a fierce belief that behind every crash, every panic, every busted system, there is something left standing. Something salvageable, even spectacular. He doesn't wait for the dust to settle. He kicks through the smoke, hunting for treasure. And that's exactly what made him one of the most legendary investors of our time. It's hard to understand the size of his instincts without going back to where he began. Born in Pittsburgh, Pennsylvania, Tepper was the kind of kid who didn't grow up around Wall Street suits or private equity speak. He grew up around steel mills and blue-collar families. He wasn't born into money. He built his identity around resilience and problem-solving. His father was an accountant, his mother an elementary school teacher. Smart, honest, hardworking. Tepper didn't dream of being rich, he dreamed of being free. And he understood early that freedom came from knowledge, from understanding how things work, from being willing to bet on himself when no one else would. After attending the University of Pittsburgh, Tepper earned his MBA from Carnegie Mellon. He landed at Republic Steel, then Keystone Mutual Funds, and finally Goldman Sachs. And it was there at Goldman that he discovered his true skill, distressed debt. While most investors were chasing growth stocks and booming sectors, Tepper gravitated toward the broken pieces. He liked companies that were in pain, systems under strain, assets that others wouldn't touch. But he wasn't just buying bad news. He was building the logic of turnarounds, understanding where the bottom was, and how to bet on the bounce. Despite his sharp insights, Tepper didn't exactly play by the internal rules at Goldman. He was loud. He challenged authority. He didn't sugarcoat things. Eventually, he was passed over for partnership, an insult that stung, but also pushed him to do what so many great investors eventually do, launch his own firm. In 1993, he founded Appaloosa Management, with just a few $1 million and a reputation for having the spine of a prizefighter and the brain of a chess master. From the start, Appaloosa wasn't a place for timidity. Tepper's strategy was bold. He dove into the worst parts of the market: bankruptcies, bailouts, distressed credit. He didn't shy away from complexity or volatility. He invited it. His logic was simple. When everyone is running away, prices collapse far below value. And if you understand the legal structure, the creditor hierarchy, and the political climate, you can buy when assets are mispriced and wait for the world to catch up. That's how he approached everything. He was one part value investor, one part street brawler. He called executives directly. He pushed back against boardrooms. He wasn't just an investor, he was a tactician. A force that made companies nervous and investors take notice. But no moment captured his brilliance more than 2009. The global financial system was cracked open. Lehman Brothers was gone. IG was unraveling. The big banks, Citigroup, Bank of America, and others were barely breathing. The fear was thick, the uncertainty paralyzing. Stocks were tanking. Credit was freezing. Even seasoned investors were frozen in place. But Tepper? He leaned in. He looked at the carnage and didn't just see a market collapsing. He saw a market overreacting. He studied the Fed's policies, the government bailouts, the TARP plan. He saw that the system, while broken, was being force-fed back to life. And that meant one thing: survival. Not of every firm, but of enough of them. Enough to bet on. And so he bet, not on safety, not on gold or cash or treasuries, but on banks. On the ugliest, most beaten-down equities available. Bank of America, Citigroup, Fifth Third. They were all trading at fire sale prices. And Tepper, in classic form, loaded up. His belief was grounded not in optimism, but in calculus. The downside was limited. These stocks were already crushed. But the upside, if he was right, was massive. And when the market rebounded, he wasn't just right. He was legendary. Appaloosa made about $7 billion that year. Tepper personally earned over $4 billion. He did it by going in when others went dark. And what made it even more stunning was his composure. He didn't panic. He didn't hedge. He believed in the math, and he had the stomach to wait for it to play out. But Tepper's genius isn't just his aggression. It's his authenticity. He doesn't wear Armani suits or speak in financial riddles. He swears in interviews. He laughs loudly. He's raw, real. He can speak markets with the precision of a Fed chair, but makes it feel like you're talking to the guy next door. He hasn't lost his edge, or his roots. He still cheers for the Pittsburgh Steelers like it's religion. He donated hundreds of millions to Carnegie Mellon not for prestige but because he believes in giving back. The money didn't change his core. It amplified it. Still, he's no saint. Tepper can be combative. He doesn't suffer fools. His shareholder letters are brutal, sometimes blistering. He doesn't mind telling a CEO he's incompetent or telling the press that they're wrong. But that fire is part of what makes him so effective. He's not there to win friends. He's there to win. When asked about his style, he once said, "The key isn't being right all the time. It's being right big when you are." That one sentence captures the soul of Appaloosa. Tepper doesn't need 1,000 small victories. He needs a few big, bold ones. And he sizes his bets accordingly. He waits, watches, and when the stars align, when market mispricing meets policy logic, he strikes with breathtaking force. What makes his story so compelling isn't just the scale of his success, but the clarity of his conviction. In a world where most people follow signals, Tepper reads them, interprets them, stays ahead of them. He's not always first, but when he's right, he's unshakable. That's the gift and the risk of playing at his level. There's no backup plan, no safety net. Just the moment, the math, and the courage to go big. That kind of courage isn't easy. Comes from years of doing the work. From knowing your own mind. From building a system of belief so solid that even when the world doubts you, you don't flinch. David Tepper doesn't flinch. And in the end, that's what separates him from the pack. He's not just an investor. He's a market warrior. A fixer. A fighter. A man who looks at a market in flames and says, "There's still something worth buying here." As we leave his story, we turn to another master. A man of words, of ideas, of sharp letters and sharper trades. Dan Loeb. Where Tepper bulldozes his way in, Loeb writes his way in. His weapons are letters, pressure, precision. His impact, just as powerful. His chapter is next. Chapter 6. Bill Ackman. Activist investing. Dan Loeb doesn't make noise for the sake of being heard. He speaks with precision, and when he does, people listen. Not because he shouts, but because his words cut through the fog with surgical clarity. Where others tiptoe around bad leadership or poor performance, Loeb charges straight in. He doesn't disguise his critiques with niceties or hide behind corporate diplomacy. He believes that change begins with truth, and truth, real unfiltered truth, has an edge. That edge is what made him one of the most feared and admired activist investors on Wall Street. With a pen sharper than a scalpel, Dan Loeb reshaped how the world viewed shareholder activism. But before the headlines, the public battles, and the legendary shareholder letters, there was a boy growing up in Santa Monica, California. His family tree hinted at ambition. His great-aunt was Ruth Handler, the woman behind the Barbie doll, and his father was a successful lawyer. Yet Loeb wasn't born into the world of hedge funds. He built his way there, layer by layer, through restless ambition and relentless thinking. At Columbia University, He studied economics and immersed himself in markets with a curious, probing mind. After college, he took on a series of investment roles, including at Warburg Pincus and Jefferies, where he sharpened his skills in high-yield bonds and learned to dissect financial statements like a crime scene investigator reading clues others had missed. Even then, Loeb had something rare, a mix of deep analytical precision and the emotional detachment to call things as they were. He wasn't afraid of confrontation. He saw underperformance not just as a business problem, but as a moral offense against shareholders. By 1995, armed with $3.3 million in seed capital and a fierce sense of conviction, he founded Third Point LLC. It wasn't just a hedge fund. It was a vehicle for calling out dysfunction wherever it hid, in bloated boards, wasteful management, or underleveraged assets. Loeb's style was unapologetically aggressive. He didn't hide behind anonymous letters or private calls. He made his critiques public, sharp, and often brutal. When he believed a company's leadership was failing, he wrote letters that didn't just expose flaws, they shamed the status quo. His 2004 letter to Stargas was legendary, not just for its bluntness but for its strategic brilliance. He called out the company's CEO as a dilettante, mocked the board for collecting compensation while the stock cratered, and laid out a path for real measurable change. The impact was instant. The board shook, investors rallied, and a new era of shareholder activism had arrived. But Loeb wasn't just trying to stir trouble. He was forcing accountability. His letters weren't tantrums, they were blueprints. They were detailed, data-driven, and crafted to push management into action. In the world of finance, where language often hides more than it reveals, Loeb's writing stripped away the pretense. He said what everyone else was thinking, but more clearly, more forcefully, and more effectively. One of his most high-profile campaigns came at Yahoo. At the time, Yahoo was struggling, bloated with bureaucracy, unsure of its identity, and losing relevance fast. Loeb took a major stake, but he didn't stop at criticizing poor performance. He investigated the CEO's resume and discovered a fabrication. Scott Thompson, Yahoo's CEO, had falsely claimed a degree in computer science. That revelation exploded across the media. Thompson resigned. Loeb gained board seats. He played a key role in bringing Marissa Mayer in as CEO, setting the stage for one of Yahoo's last real attempts at reinvention. And when Loeb exited the position, it was with billions in returns and a reputation cemented. The truth is, Loeb's success isn't just about being loud, it's about being right. He does the work. Third Point's analysis is meticulous. His team doesn't shoot from the hip. They dismantle financial structures, look under every stone, model every outcome. His activism is rooted in logic, not emotion. But once he sees the truth, he doesn't hold back. And that makes people nervous. Because Dan Loeb isn't the kind of investor who just wants a seat at the table. He wants to rebuild the table entirely. Yet, for all his public fire, there's another side to Loeb. One less known but just as essential. He's deeply introspective. A practitioner of yoga and meditation, he's as interested in mastering his inner world as he is in restructuring a company. He once described a losing trade not just in financial terms, but in emotional ones, asking himself why he made the decision, what fear or overconfidence might have been at play. That kind of self-inquiry is rare in finance. It reveals a man who isn't just fighting for shareholder returns. He's chasing self-mastery. This duality, ruthless analysis and quiet reflection, is what makes Loeb so effective. He isn't bound by a rigid playbook. He's nimble. Third Point is known for its flexibility, moving between equities, credit, macro trades, and event-driven plays. Loeb isn't a value purist or a growth fanatic. He's a realist. He sees the world as it is and he adapts. That's his edge. And in markets where rigidity is punished, Loeb thrives. He once said, "I do this job not just for money, but because it's a reflection of who I am." That statement matters. Because for all the billions he's made, Loeb remains obsessed with clarity of thought, of purpose, of action. His letters aren't just missives to the market. They're reflections of a worldview that doesn't tolerate mediocrity or delay. In a world filled with polite inaction, Loeb acts. And yes, his critics say he's too brash, too personal, too aggressive. But even they have to admit, he gets results. He doesn't play nice. He plays honest. And that kind of honesty, when backed by insight and courage, is disruptive in the best possible way. As the chapter closes, you're left not with the image of a man screaming across a boardroom, but a man alone at his desk, writing, thinking, weighing the facts, choosing each word with care and intention. Because for Dan Loeb, the pen truly is a sword, and he wields it with devastating precision. Next, we journey into the world of Bill Ackman, a man of grand visions, sweeping narratives, and public showdowns. Where Loeb slices with a letter, Ackman charges with a campaign. Bold, driven, and always under the spotlight, Ackman's story is as much about redemption as it is about risk. Chapter 7. Daniel Loeb. Activism/poison pen. There's a particular intensity in the way Bill Ackman moves through the world. It's not loud in the traditional sense, it's not bluster or bravado, but it hums beneath the surface like voltage. He doesn't just invest in companies, he immerses himself in them. He sees business as something not to observe passively from the sidelines, but to engage with directly, often forcefully, and always with purpose. His story isn't just about numbers, it's about belief. It's about standing on a platform in front of the world and saying, "This is what I see," and then staking everything on it, even when the crowd is booing. Especially when the crowd is booing. Born in 1966 and raised in Chappaqua, New York, Ackman didn't come from obscurity. His father was a successful real estate executive, but privilege never dulled his ambition. It sharpened it. He attended Harvard, both undergraduate and business school, and emerged with not only a sharp analytical mind, but also a deep desire to challenge the status quo. Ackman's approach to investing has always had this dual nature. Part cold calculation, part missionary zeal. He doesn't just want to be right, he wants to fix what's wrong. His first investment firm, Gotham Partners, launched in the early 1990s, was ambitious, idealistic, and ultimately short-lived. A combination of legal headaches, illiquidity, and tangled portfolio positions brought the firm down. Many investors, burned and humiliated, might have disappeared after such a defeat. But not Ackman. He treated the failure like a crucible, a place of reckoning and refining. In 2004, he launched Pershing Square Capital Management with a clean slate and a fiercer sense of purpose. Pershing Square would be built differently. Ackman envisioned a firm that wouldn't just find mispriced stocks but would engage in high-impact investing. Activism with a moral spine. He believed that shareholders should have a voice, and that voice should be loud, especially when companies strayed from their obligations to maximize value. It wasn't about short-termism, it was about accountability, and Ackman would lead that charge, often with a camera in his face and his name in the headlines. One of his earliest campaigns with Pershing Square was against MBIA, the monoline insurer. It wasn't a typical activist position. He shorted the stock and spent years building a public case against the company's creditworthiness. Most investors quietly placed their bets. Ackman wrote a book-length analysis and mailed it to regulators, rating agencies, journalists, anyone who would listen. People mocked him. The company called him a fearmonger. But when the 2008 financial crisis hit, everything Ackman had warned about became reality. MBIA was overleveraged. Its exposure to risky structured products nearly sunk it. Ackman's thesis played out in brutal clarity. And in the aftermath, he was no longer dismissed as a troublemaker. He was seen as a prophet. That success, however, came with a cost. The reputation he built for conviction was now an expectation. He would carry it into future battles, including one of the most painful of his career, Herbalife. In 2012, Ackman took a $1 billion short position against Herbalife, publicly accusing the company of being a pyramid scheme. It was one of the most audacious and controversial activist moves in modern investing. He didn't simply bet against the company. He waged war. He produced documentaries, lobbied lawmakers, and held presentations that felt more like courtroom trials than investor pitches. Ackman wasn't just challenging a stock. He was accusing the company of moral wrongdoing, of exploiting vulnerable people around the world. His passion was raw, his arguments detailed, his belief unshakable. But Herbalife didn't collapse. Didn't even crack. If anything, it fought back harder. It hired lobbyists. It launched PR offensives. And then Carl Icahn entered the arena, an investing titan and Ackman's philosophical opposite, who took a long position in Herbalife and began attacking Ackman publicly. The two clashed in interviews on stage and through the press. What had started as an investment thesis became a televised feud. And over the course of several years, despite modest regulatory fines against Herbalife and minor business changes, the stock recovered. Ackman eventually exited the position at a substantial loss. It was humiliating. It was public. And it shook his fund's credibility. But here's what makes Bill Ackman extraordinary. He doesn't run from the fire. He studies it, walks through it, and takes notes. After Herbalife, Pershing Square's performance suffered. There were other painful positions, Valiant Pharmaceuticals being one of the most devastating, where Ackman doubled down as the company spiraled into controversy. His fund's returns plummeted. Investors grumbled. Commentators called him overconfident, stubborn, even reckless. He could have quietly stepped back, blamed his team, pivoted to something safer. But instead, Ackman restructured his firm. He simplified. He returned to his roots, long-term concentrated bets on high-quality businesses. He focused on companies with strong cash flows, capable management, and strategic clarity. His humility didn't erase his conviction. It refined it. And from that refined clarity came a comeback that stunned even his critics. When COVID-19 began to spread in early 2020, while the world was still debating its impact, Ackman acted. He spent just $27 million buying credit protection on investment-grade and high-yield bonds, essentially betting that credit markets would freeze. When they did, that hedge returned $2.6 billion. In just a matter of weeks. It was one of the most profitable, well-timed trades in modern hedge fund history. But Ackman didn't gloat. He went on television, his voice breaking, his words trembling, and begged the U.S. government to shut down the economy temporarily to save lives. It wasn't just an investor warning. It was a plea. The world saw, maybe for the first time, that underneath the tailored suits and public confidence, there was a man who cared. Deeply. Maybe too deeply. But genuinely. That humanity is what makes Ackman's story so enduring. He's not just a high-conviction investor. He's an emotional one. When he believes in something, whether it's a company, a cause, or a thesis, he doesn't let go. That can be dangerous. But it's also what gives him his strength. He learns. He evolves. He doesn't hide from losses. He publishes them in his investor letters, dissects them publicly, and uses them to sharpen his craft. Today, Pershing Square manages billions, and its core positions, names like Chipotle, Lowe's, and Universal Music Group, reflect a more measured, mature Ackman. The activist fire still burns, but now it's tempered with patience, focus, wisdom earned through bruises. Ackman's journey is a reminder that in investing, as in life, conviction is only as powerful as your capacity to reflect. That ego must bow to evidence. And that even in failure, there is the possibility of redemption if you're honest, if you're open, and if you're willing to begin again. Next, we step into the more mysterious world of Boaz Weinstein. A chess prodigy turned credit derivatives maestro, Weinstein doesn't court attention like Ackman or Loeb. Instead, he plays the volatility of the market like a symphony, complex, cerebral, and always a few moves ahead. Chapter 8. Jim Chanos, Short Selling/Deep Analysis. Boaz Weinstein doesn't fit the typical image of a Wall Street alpha. There's no brash swagger, no headline-grabbing proclamations, no desperate need to be in the spotlight. Instead, he operates with the focused intensity of a chess grandmaster, which not coincidentally he once was. From the time he was a child, Weinstein viewed the world through a lens of strategy and possibilities. Born and raised in New York, he was playing chess at age 5 and achieving the rank of national master before most teenagers had even learned to drive. But it wasn't just about winning matches. It was about building an internal compass, a way of seeing 10 moves ahead, a mental map of decisions and consequences. And as it turns out, that mindset translated almost perfectly into the complex, opaque, and often volatile world of credit derivatives. Weinstein began his financial career at Deutsche Bank, entering the trading floor with the quiet confidence of someone who knew he could see things others missed. While most traders fixated on equities or commodities, straightforward asset classes with public visibility, Weinstein gravitated toward the labyrinth of credit markets, particularly credit default swaps. These instruments, misunderstood by many, became his playground. They offered nuance, hidden opportunity, complexity, And that was exactly what he wanted. He didn't crave the rush of market speculation. He craved the intellectual rigor of solving puzzles that no one else had the patience or skill to solve. At Deutsche Bank, he quickly rose through the ranks, eventually running the Saba Principal Strategies Group, managing tens of billions of dollars. Under his leadership, the team produced extraordinary results, navigating the early 2000s with precision and care. And then came the 2008 financial crisis, a storm so violent it shook the very pillars of global finance. Yet Weinstein's approach, rooted in risk awareness and diversification across credit structures, helped his team hold firm while others were being swept away. He understood correlations. He understood downside exposure. He understood that models break under stress, but discipline doesn't have to. But in that post-crisis world, Weinstein saw an opportunity, the chance to create his own firm on his own terms. So in 2009, he launched Saba Capital Management. The name, Saba, Hebrew for grandfather, hinted at something wise and enduring. This wasn't a flashy startup. It was a precision instrument. Weinstein intended to bring institutional discipline and a mathematical edge to a world that still too often relied on instinct. And almost immediately, Saba made its mark. Weinstein's style wasn't to make sweeping macro bets or shout predictions from the rooftops. His firm dissected markets, identified inefficiencies, and built asymmetric trades, positions where the downside was contained, but the upside could be exponential. He was, above all, a volatility trader, someone who didn't try to predict whether markets would go up or down, but rather bet that they would move. That core thesis, that volatility itself was an asset, allowed him to structure trades that profited when others were paralyzed. But perhaps Weinstein's most famous moment came not from a complex trade, but from a simple observation. Someone somewhere was taking up too much space. In 2012, the London office of JP Morgan Chase had quietly built up a massive credit derivatives position, so large and unusual that it began distorting market prices. Weinstein, with his deep knowledge of credit, noticed. He began taking the other side of the trade. Slowly, carefully, methodically. And then the story broke. A JP Morgan trader, soon nicknamed the London Whale, had amassed such enormous exposures that even JP Morgan couldn't unwind them without bleeding billions. Weinstein had not only anticipated the collapse, he had positioned Saba perfectly to profit from it. While JP Morgan lost over $6 billion, Saba's gains soared. It was a watershed moment. One of Wall Street's quietest minds had outmaneuvered one of its most powerful institutions, not through bravado, but through discipline and clarity. Yet even in victory, Weinstein remained grounded. He didn't chase media attention. He didn't try to spin a legend around himself. He went back to work. Because for Weinstein, trading isn't about triumph or drama. It's about understanding the true nature of risk. He is obsessed with probabilities, with tail events, with how things correlate in unexpected ways. His thinking is multidimensional. Where others see charts, he sees systems, networks of behavior, feedback loops, human psychology embedded in numbers. He builds trades like a composer builds symphonies, with attention to balance, tension, and resolution. One of the more fascinating chapters in his career came as Saba began targeting closed-end funds, obscure investment vehicles that often trade at discounts to the value of the assets they hold. For most investors, this space is too small, too sleepy. But Weinstein saw opportunity. These funds, he realized, could be pressured into closing the gap between market price and net asset value. It was activist investing, but without the noise. No CEO takedowns. No viral letters. Just carefully structured campaigns, backed by math and logic, designed to unlock trapped value. And again, it worked. But it wasn't just about making money. For Weinstein, managing risk was almost a spiritual exercise. He spent years refining not just his strategies but his own emotional discipline. He knew that even the best ideas could fail. That markets were complex organisms with moods and biases. That conviction was dangerous without humility. He surrounded himself with people who challenged his thinking. He built models that stress-tested every position against black swan events. He knew that survival in markets wasn't about genius, it was about control. That humility, combined with his remarkable intelligence, has made Weinstein a rare figure in modern finance. A man who thrives in the background, whose brilliance reveals itself not in sound bites but in returns, not in charisma but in resilience. He isn't looking for fame. He's looking for edge. What makes him so compelling is that he plays the long game, not just in the markets but in life. He doesn't rush. He doesn't overreach. He watches, waits, and acts when the odds tilt in his favor. And that patience has allowed Saba to flourish in environments where others falter. As we step away from Weinstein's story, we're reminded that some of the most powerful players in finance don't shout. They think. They prepare. They execute. And while the headlines may belong to the loudest voices, the true alpha, the enduring kind, is often generated by those who master silence, who embrace complexity, and who never stop asking what happens if we're wrong. Next, we turn the page to Jim Chanos, the legendary short seller who doesn't look for opportunity in success, but in failure. A man who made his name uncovering fraud, challenging icons, and betting against the illusion of growth. Chapter 9. Boaz Weinstein, Derivatives/Credit Strategies. Jim Chanos is the kind of investor who walks into the room just as everyone else is clapping, and instead of joining in, he asks, why? He doesn't buy the hype. He doesn't trust the sizzle. He reads between the lines, pokes at the numbers, and turns over stones to see what's crawling underneath. In a market culture that idolizes growth and celebrates optimism, Chanos plays the role of the skeptic. He questions. He challenges. He bets against the parade. And while that role might make some people uncomfortable, for Chanos, it's a mission. It's not about negativity, it's about accountability. Because when the world wants to believe a story so badly it ignores the truth, someone has to ask the uncomfortable questions. Jim Chanos made a career out of doing exactly that. Born in Milwaukee, Wisconsin in 1957, Chanos came from a Greek-American family and grew up in a world far from Wall Street glitz. He studied economics and political science at Yale, which gave him a foundation in understanding systems, incentives, and power. But it wasn't until he started working in finance that he realized how much fiction was embedded in the way companies talked about themselves. Early in his career, while analyzing a seemingly impressive company called Baldwin United, he noticed inconsistencies in the numbers. While everyone else was celebrating the firm's growth, Chanos quietly concluded that it was an illusion. Not long after, Baldwin United collapsed in one of the biggest bankruptcies of its time. For Chanos, it was a light bulb moment. He had spotted the lie early, and it had paid off. That moment didn't just validate his instincts. It charted the course for his future. Chanos saw that while most of the financial world was built around optimism, there was almost no institutional appetite for disciplined skepticism. So in 1985, he launched his own firm, Kynikos Associates. The name, drawn from the Greek word for cynic, was no accident. Chanos wanted to carve out a space where rigorous analysis could puncture inflated narratives, where truth mattered more than trend, and where shorting wasn't about betting against success but exposing lies hidden beneath it. But being a short seller isn't glamorous. It's lonely work. It means spending your time analyzing companies that others adore. It means going against the current when the current is sweeping everything upward. And worst of all, even when you're right, you're often early. And in markets, being early is nearly the same as being wrong. Yet Chanos never wavered. He believed that every market cycle brings its heroes, but also its pretenders, its manipulators, its frauds. And when the euphoria peaks, those pretenders need someone to call their bluff. Chanos made that his job. Nowhere was that calling clearer than with Enron. In the late 1990s, Enron was the darling of corporate America. It wasn't just an energy company. It was reinventing itself as a kind of financial supermarket, a place that claimed to trade not only power but ideas, whether derivatives, bandwidth futures, whatever buzzword might excite investors. The stock soared. Analysts raved. Fortune magazine called it America's most innovative company. But Chanos, as always, wasn't seduced. He looked at the numbers. He read the footnotes. He saw a business that was too complicated, too opaque, and too perfect on paper. He started asking, how is this company actually generating its profits? And when he couldn't get a straight answer, he started shorting the stock. At the time, shorting Enron felt almost sacrilegious. It was loved by the media, praised by policymakers, admired by Wall Street. But Chanos trusted his process. And eventually the truth unraveled. Enron wasn't just overvalued, it was a house of cards. The company had hidden debt, off-the-books entities manipulated earnings. When it collapsed in 2001, it became one of the largest corporate scandals in history. Chanos didn't just profit from the fall. He had seen it coming when few others even dared to look. And yet, that victory didn't make him complacent. If anything, it reinforced his belief that bubbles are baked into human behavior. That markets, left unchecked, will always overreach. That every boom carries the seeds of its own unraveling. Over the years, Chanos applied his forensic lens to companies like Tyco, WorldCom, and others. His targets weren't small fry, they were giants. And in most cases he was dismissed at first, even mocked. But when the dust settled, Chanos's warnings usually looked more like wisdom than cynicism. What makes his approach unique isn't just his skepticism. It's the discipline behind it. Chanos doesn't bet against companies based on rumors or hunches. He builds cases. He studies accounting statements like a prosecutor preparing for trial. He looks for gaps between earnings and cash flow, for aggressive revenue recognition tactics, for unsustainable business models hiding behind buzzwords. His team at Kinekos isn't just a trading outfit, it's an investigative unit. They don't trade emotions. They trade evidence. But being right doesn't make the journey easy. Short selling is punishing. The market's natural direction is up, which means short sellers are always fighting gravity. Worse, when a short position is correct, the payoff is capped. The stock can only go to zero. But if it's wrong, the losses can be infinite. It's asymmetric, unforgiving. And because short sellers challenge popular narratives, they often become villains in the public eye. Yet Chanos has accepted all of that. To him, it's not a role, it's a responsibility. Someone has to stand in the path of irrational exuberance. And in more recent years, he's taken on new types of giants, companies like Tesla, where valuation soared far beyond traditional metrics, and certain Chinese firms he believed were manipulating data or misleading investors. His views haven't always been popular, and his positions haven't always worked. But Chanos never claims to be infallible. What he insists on is rigor, transparency, and a belief that the truth will, eventually matter. What Chanos teaches us is that finance needs more than celebration. It needs scrutiny. That progress is real, but so is deception. That hype is not the same as value. In a world increasingly driven by stories, by personalities, by momentum, he remains a man who returns to the numbers, who reads the 10Ks, the footnotes, the disclosures, and who understands that while the market may be a voting machine in the short run, in the long run it's a weighing machine, and eventually every inflated story gets weighed. He reminds us that courage doesn't always roar. Sometimes it whispers, "I disagree," when the room is full of applause. Sometimes it holds a short position for years even as the market mocks you because the data says you're right. Sometimes it means being the only one willing to ask, what if this company is lying? Jim Chanos is not the loudest voice in finance, but he is one of the most principled. His story, like those of the other alpha masters, reveals that real success in investing comes not from luck or flash, but from discipline, integrity, and a willingness to challenge the comfortable myths we tell ourselves. He doesn't bet on dreams, he bets on reality. And sometimes that's the bravest bet of all.